10 things you must know and understand about interest rates today on Major Money Matters. Welcome to Major Money Matters. My name is Major. I'm a mortgage broker powered by Edge Home Finance. And today we're going to talk about 10 things you must know and understand about interest rates. Now, before we get started on these 10 things, if you have not already, go ahead and like and subscribe to the channel so that you get updates when we post videos like this and when we post our weekly market updates on what's going on in the economic front and how it affects the housing market. So let's get right down to it. There are 10 things that you must know and understand about interest rates. And this is the type of stuff that you should have learned while they were teaching you things like trigonometry and calculus, things you likely do not use today unless you're an actual mathematician. But it is likely that you are one day going to buy a home and desire to buy a home. And how much you understand this topic and understand this process could have a great impact on your experience while you are buying a home. And it makes the process that much easier when you have wisdom, knowledge, and understanding. So let's start with number one. The first thing that you must understand about interest rates is that interest rates change daily, sometimes multiple times in a day. As of the recording of this video, we're currently in an increasing interest rate environment. There's a lot of things going on like inflation, the Federal Reserve making a lot of adjustments to things. And every time you hear Jerome Powell speaking, you hear the president speaking, you hear somebody that has a lot of impact on the world economy speaking, you're likely going to see a lot of volatility in the market. So you need to understand that interest rates change daily and you should not be fixed on an interest rate that was recorded to you last week, because that interest rate could be very, very different if you call up a mortgage professional on today or on tomorrow. So number one, they change daily. Number two, there are nearly 30 different factors that can affect your interest rate, your credit score, your loan amount, the purpose of that loan, whether that loan is for a purchase or a refinance or a second home, the loan term of that home, whether that home is for a 10-year loan, a 15-year loan, or a 30-year fixed loan. These go on and on and on, and there are many different variables that could affect your interest rate. You could be in a situation where you're buying a $700,000 home in California or Hawaii, where the conforming loan limit is a little over $970,000, and you could have one interest rate and you could change your mind at the last minute and say, wait a minute, I want to go to Texas and I still want to buy a $700,000 home. Well, you're going to have a different interest rate because that $700,000 home is above the conforming loan limit in Texas, which is about $647,000. So that is going to have an impact on your interest rate. And if you change these variables within your own scenario, or if you try to compare your situation to someone else's situation in another state or with another loan amount or something like that, you could have very different interest rates. So number two, understand that there are many, over 30 different variables that could affect your interest rate. Number three, interest rate is relative to the risk for the investor. And when I say the risk for an investor, I mean the bank that is giving you that loan. For example, let's say you're buying a primary property. All right, if you're buying a primary property, the investor assumes that if things get hard, the first thing you're going to do is make sure your primary property's payment is made, because that's where you sleep at night. That is your primary property. So that interest rate is going to be lower than on an investment property, because the investor assumes that if things get hard for you or you start losing a job or something like that, then you may not pay the payment on the investment property, because if that property goes into foreclosure, you don't really care because it is an investment property, not your primary property. So this is why Another reason that this comes into play is because, the investor assumes that if you have a 750 credit score, you have a responsible use of credit and you're used to paying your bills on time. If you're in that range, you're probably a safe investment. However, if your credit score is 630 or 620, that keys to them that there's greater risk there. So you have to understand that your interest rate is most of the times based on how the investor or the bank sees you and how much of a credit risk they see you as. Number 4, you never have an option of just one single interest rate. Let me explain to you how this works. When you go to lock in your interest rate, you should, if you're working with a reputable lender, have an option of varying your desires among their rate scale. For example, let's say you call them up and the par interest rate is 3.5, for example. Now, understand what I mean when I say par. That means the interest rate without paying any points or any buy down or any extra amount into your closing costs in order to get a lower interest rate, and that is the amount at which there is no credit. For example, you're not taking a higher interest rate in order to get lender credits, or what some people refer to as premium pricing, where you're taking a higher interest rate in order to get credits from the lender in order to cover your closing costs. You want the baseline interest rate. This is what the baseline interest rate is. So let's say, for the purpose of this example, our baseline interest rate with no points and no credit is 3.5. You have the option of buying down that interest rate in order to get a lower payment and a lower interest rate if you desire to do that. You also have the option of taking a higher interest rate if you desire some of your closing costs to be paid. So understand that you can slide along a scale from maybe 3.5 to 3.0 if you want your payment to be lower, or if it makes sense to buy down. Or you can take a higher interest rate from 3.5 to 4.0 in order to get lender credits or help towards your closing costs. So you never have just one option or one interest rate when you go to lock in your loan or lock in your refinance, whatever you're doing, whatever you're using your mortgage for. That is number 4. Number 5, and this is probably my favorite one, the Federal Reserve has no direct impact on mortgage interest rate. Okay, so the Federal Reserve increases the Fed funds rates when they're trying to hedge against inflation or trying to decrease inflation. They decrease the Fed funds rate when they are trying to stimulate the economy or prevent us from going into a recession. But them increasing and decreasing the Fed funds rate has no direct impact on mortgage interest rates. So just because the Federal Reserve increases the Fed funds rate does not mean that your interest rate is going to go up. Actually, most times the markets react favorably to the Fed increasing rates. So it's often that you have a lower interest rate when the Federal Reserve actually increases the interest rate. So I'm not going to go into that very deeply, but if you want more information on that, you should look at the video on the channel entitled "The Real Reason Interest Rates Are Rising." So the Federal Reserve has no direct impact on mortgage interest rates. Number 6, lowest interest rate does not necessarily mean the best product for you. Lowest interest rate does not mean that somebody is giving you what's in your best interest. All right, so you could have a slightly higher interest rate and you can be making decisions that's in your best interest. Let's say, go back to our previous example. Let's say your par rate is 3.5, but you want to take a 3.8 to get lender credits to help cover your closing costs because you don't want to take your money out of your investments or something like that. You definitely can do that, and that is certainly an option. I actually have a product right now that I broker through United Wholesale Mortgage called MI Buster, and in this program you can take a slightly higher interest rate and put 10% down on a conventional loan and not have PMI. Now, it's not prepaid PMI. By the way, if you don't know, PMI is private mortgage insurance. Normally, anytime that you don't put down at least 20% down on a conventional loan, you're going to have PMI. But United Wholesale Mortgage has a program that if you select MI Buster, that as they call it, you can put 10% down, or actually 10.01 technically, and not have PMI. So that program can help you have a lower monthly payment because you're not paying PMI. But if you were just focused on the interest rate, then you could end up structuring your loan in such a way where it gives you a higher monthly payment, and it's not in your best interest. So lower interest rate does not always equal the best product for you. Number 7, interest rate is an important thing, but not the most important thing when you're selecting what company you want to work with or what mortgage professional you want to work with. Look, I understand and respect the fact that you want to pursue the best interest rate for yourself. But if you're calling up an online mortgage bank or something like that, you might get a pre-qualification or pre-approval from that bank. But when you submit the offer and you're trying to buy a house, and the listing agent is trying to call the company or call that loan officer to have a conversation with them about your qualifications, insert online brokerage here, which I don't want to call anybody out specifically, but that company may not answer the phone and may not talk directly to your situation. So it's much better that you're working with a mortgage professional who is going to help you get your offer accepted and work with you to walk you through this entire process of home buying or home refinance or something like that. There are also other factors to consider besides interest rate. How much in fees are you paying to get that interest rate? Now, if you're comfortable paying the fees to get that rate, then that's fine. But you also need to be aware that you're paying those fees to get that interest rate. Professionalism, access. Can you get in touch with your mortgage professional when you need to ask questions, whether that's by phone or by email? I'm not saying that that justifies a higher rate, but I'm just saying if you just are looking by rate and rate alone, you could find yourself in a situation where you're chasing a rate. And I will tell you that an interest rate on an offer that you can't not get accepted, doesn't really matter, because it doesn't matter if you're actually until you're actually in the home, what your interest rate is. So interest rate is an important thing, but not the most important thing when you're shopping for a mortgage professional. Number 8, interest rate is not the only thing that affects your mortgage payment. Everybody gets excited when they said, hey, I want to make more money in my home. I want to buy a property and then I want that property to appreciate and I want to make money in that home. What they don't consider is that by you making money in that home, or that the value of that home increasing, your property taxes also increases with the value of that home increasing. So your property tax increase, or the assessment on your home increasing, means that you're going to pay more in property taxes. You could end up paying more in homeowners insurance. So the fact that your interest rate goes from 3.5 to 3.6 may not be as big of a deal long term as it is the other different factors that affect your monthly payment. So keep in mind that there are other factors beyond interest rate that do actually affect your monthly payment. Number 9, interest rate does not determine how savvy you are financially. Now, the reason I like being a mortgage broker is because I get to work with different types of clients, whether those clients are buying their first home, which is amazing, whether those clients are selling a home and moving on to another home, it's great. Or I have some investor clients that are using different types of loan products in order to purchase homes and purchase them quickly, whether those are called DSCR loans, debt servicing coverage ratio loans, or bank statement loans. And I have learned that with my wealthier clients, or my more savvy clients that are looking at different products, you will say an interest rate to them of what those products are. And in general, those investor products are a higher interest rate than a primary property on a first-time home buyer or something like that. But the investor products are higher. They say to me, Major, the interest rate is the interest rate. Let's move on. because they are more concerned with cash flow than they are concerned about interest rate. They're more concerned about what they plan to do and how quickly they plan to pay the house off, because frankly, they have a large amount of cash. So interest rate alone does not determine how savvy you are financially with your finances as a whole when you're talking about, buying property. Number 10, and finally, interest rate does not determine your self-worth. I've seen this happen many times. People are hanging out at a barbecue. One person says my interest rate is 2.5. The other person says my interest rate is 3.2. And you get into this, well, I feel bad because my interest rate is higher. But the truth is, you don't know what else went into just that interest rate. You don't know the timing that went into getting that interest rate. You don't know what points they paid or what fees they paid on that interest rate. You don't know whether they paid, $30,000 in fees on a mortgage that they're going to stay in for 3 years, and then they're going to sell that property and move on. And you start to feel down because you don't have as low of an interest rate. It's interesting when people start talking about this topic, they sometimes get emotional and feel down because somebody else got a different interest rate or a quote unquote better interest rate than they did. But I encourage you that interest rate does not determine your self-worth. Interest rate is simply a tool to accomplish what you need to accomplish at a given time. It's a tool it's a price you pay for a loan in order to accomplish your objective. So interest rate in no way determines your self-worth. It's lots of times it's about timing when you're getting a specific rate. But don't let comparing yourself to another person, and this is just life in general, don't let comparison be the enemy of your joy, because you're happy with the house until you go tell somebody else, I got this rate, and they say we have this rate, and you start feeling down about yourself. Interest rate does not determine your self-worth. 10 things that you should have learned about interest rate in high school, but now you get to learn it now. So God bless. See you next time on Major Money Matters.